Welcome to the ETF.com video series. I'm Laura Krieger and I'm here at Inside ETFs with Nick Good, who is the co-head of the Global SPDR business for State Street. Now, Nick, earlier in the conference you were on the Future of ETFs panel and you had quite a bit of applause when you said definitively that no, we should not launch Bitcoin ETFs. So I was wondering if you could talk a little bit why you feel that way.
Sure. I believe that we, as an industry, actually do operate with our investors' interests at heart. We're generally a pretty thoughtful group of people. I mean, the ETF industry was invented as a way of delivering better returns for investors. And I think we take that fiduciary responsibility seriously. And if we take that fiduciary responsibility seriously, we should be creating products that ultimately we believe are in investors' interests. Bitcoin is speculative. By anyone's estimation, Bitcoin is speculative. And we should not be supporting speculative instruments. If people want to invest in that, that's their business. But if we care about responsible investing, that's not what we do. And I think it's inappropriate for an industry of our kind to be supporting that.
Mm-hmm. How about blockchain? Do you feel the same way about those sorts of technologies, which is blockchain being the technology that underpins cryptocurrencies?
Blockchain's a technology. It's like investing in any technology. It's like saying, do you invest in internet companies? There are valuations that are absurd associated with anyone that has put the word blockchain in anything they're doing. Understanding how it will impact companies and investing appropriately, yeah, there's a real basis to that. There's a valuation that you can apply to it. It will yield either revenue or reduce costs that can translate to investor returns. So to the degree that gets reflected in investments, yeah, it makes sense. But that's very different than investing in what's ultimately speculative.
Sure. So looking forward, what is one ETF trend that you do see as an opportunity for the future?
So for us, it's a pretty obvious one, which is the ultra low cost ETFs. Right. 60% of flows went into low cost ETFs last year. It's an area that we had been asked for a long time by our clients to be part of. We would hear consistently they wanted to do more business with us, they wanted us to be part of their core, and this wasn't a space we were in. And frankly, we felt that if you just launch funds, no one's going to buy them. If they weren't liquid, if they didn't have assets. So we worked really hard over the course of last year to launch our ultra low cost series, 15 ETFs. They had assets, they were liquid, they had tight spreads, they were simple, we reduced the share prices, we did a lot of stuff right. And in the 3 months since we've launched, we've raised $8.2 billion, which has been staggering. And it speaks to the fact there was real demand for someone else to be in that space, and so that's been really pleasing to see.
We're seeing a real race to the bottom in terms of fees, especially from the big three issuers, including State Street. Is there a point that we're going to reach where ultra low cost can't get any more ultra low? Or are we going to hit a bottom?
So I think we're already starting to hit it, and you've seen the sort of decrease in fees has slowed down. There's still an awful lot of money tied up in high-cost active mutual funds that aren't delivering. But within the core space, we're getting to a point where the variable costs, there'll be some slight declines, but the variable costs are getting pretty tight. We had to work really, really hard to get to these price points that we got to. There's an argument out there of, could you get zero management fee ETFs? And I think investors should be worried if we get to that, because somebody's making money on that somehow, and so the securities lending splits or other behind-the-scenes fees would be a concern. So I think we're getting to the point where the management fees can just about cover variable costs, and I think it'll start to slow down in terms of further declines. The other thing to bear in mind, there's an investor. For a long time, the biggest costs have been the management fees. Now it gets down to trading spreads, it gets down to commissions. So as it gets down to very low single-digit basis points, actually it's the rest of the expense that has a bigger impact on investors. So really, that's where I think you'll see further price compression.
There has been a lot of chatter at this conference about AI, machine learning, disruptive technology, and I know that State Street just released 3 innovative industry ETFs. So I was wondering if you could talk a little bit about them. What makes your disruptive tech ETFs different?
So we're actually really excited about this. And I think it actually goes to where we are as a firm, that on one side we're meeting customers' needs with the low cost, and the other we're continuing to create products that we can really get behind and not just throwing stuff at a wall. These are based off Kensho indices. So Kensho is a company out of Cambridge, Mass. It's a firm we know well. They've been doing this for a long time, and they've really used AI to really sort of scour company filings and reports to essentially identify companies that are exposed to certain technologies. So for example, one of the products we've launched has a portion of it's in drones. It's not just buying companies that make drones, it's buying companies that make rotors, that make the underpinning aerodynamics, that really sort of ultimately underpin that industry and therefore exposed to a general trend. And the way they've used AI and algorithms to sort of scour the internet to identify these companies is what's really impressive. And for us, I think that's actually a big area that we differentiate on, is our ability to find good partners. If that's not something that we do, we will go out and find the people that we think are best in the industry at doing that. So it's really, really
I would
good.
love to talk more about this, but unfortunately we have to leave it there for now. So thank you very much, Nick, for sitting down and chatting with me, taking some time out at Inside ETFs. I've been speaking with Nick Good, who is the co-head of Global Spider Business for State Street, and I am Laura Krieger. And for more videos, please check out the rest of our Inside ETFs video series at ETF.com. Thank you.